Hello everyone and welcome to our third class. In this class, we will discuss international flow of funds. So as you may know, nowadays the globalization effect. We live in one big country. So basically Malaysia, Indonesia, Malaysia, neighboring countries, US, we have very strong relations, right? We buy and sell. Basically, we have relations. We invest over there. Some companies in the US operate in Malaysia, etc. So flow of funds recently increased massively. So nowadays it's very difficult for you to even know sometimes where is this company from, right? Sometimes we ask ourselves, what's this company from, right? And we Google it. We don't even know where MNCs are from nowadays. It's not even easy because there is a big amount of MNCs. Every day we find a new company in doing business in new countries. So we will start with explaining the key components of balance of payments. So similar to companies, individuals, countries also keep track of these transactions. So sometimes they buy from US, sometimes you sell to US, sometimes you invest in US, sometimes US people come and invest here. So we must keep a balance of payments, we're gonna call it, to keep track of things. Then we will discuss, of course, you already know that international trade is growing massively, right? Let's say, for example, now we can hire people from outside. We pay them, we send them the salary, especially after this WFH, right? Working from home. Everyone can be hired all across the world. Then we're gonna discuss international trade flows. They are influenced by some factors. So, do all countries have the same level of exchange with other countries? No, maybe some export more, some import more, etc. Then we will move the discussion to how international capital flows are influenced by country characteristics. So, do Malaysia attract more people than Indonesia? That's a question, right? Why? Why would Malaysia attract investors? Why would Malaysia attract people to work in? Why would it attract tourists? Many reasons, right? Many factors. Finally, we will discuss the agencies that facilitate international flow of trade. So international flow of funds and trade didn't, came out of the blue. It was basically progressive, right? It gradually increased the size and the volume and everything about it didn't really change in overnight, right? It took time. So there are some institutions that are encouraging us to do that, facilitating, by preserving rights, etc. So we will take a look at that. So let's begin. Let's begin with the balance of payments. What does it mean? It's the summary of transactions, as I told you. Uh, let's say myself, I want to keep track of my transactions. So every cash inflow should be recorded, every cash outflow must be recorded as well. Similarly, US, Malaysia shall do the same thing. So it's a summary of transactions between domestic and foreign residents for a specific country over a specified period of time, usually 1 year. It's also known as balance of international payments, encompasses all transactions between a company's residents and its non-residents involving goods, services, and income. What kind of income? Maybe, as I told you, I invest in Indonesia. I buy stocks. Maybe I have a loan in Philippines, etc. So, financial claims on and liabilities to the rest of the world, and transfers such as gifts. What about gifts? Let's say Japan suffered during tsunami. We want to send some aid or help, gift. Again, that will play a role in the balance of payments. So how do we determine what things to be recorded? We will see today, but in general, anything that will affect cash inflow, cash outflow must be there. Similar with, keeping track in business or even in personal expenses. Okay, let's focus on the components. So, what do we see in balance of payments? We will categorize things. We're not gonna just keep it random. We're gonna categorize these things into three groups. Current account. What is current account? Summary of flow of funds due to purchase of goods and services. Okay, so purchase of goods and services. So I bought raw materials from Philippines, must be there. Okay, I sold CPO to US, must be there. What about capital account? As the name suggests, capital. Summary of flow of funds resulting from the sale of assets. So I want to purchase espresso machines from Germany. So from Malaysia, cash outflow. For Germany, cash inflow. Between one specified country and all countries. It's the same for everything. So it's one country against all countries, not one country, all countries of the world. Financial account, finally, what's financial? Against its financial refers to special type of investment. So now it's financial. It's more about real investment. Usually countries target this type of investment. Why? Because it brings more business. You hire people in my country, you buy assets, you buy land, maybe you buy, many things. Assets can be machinery, can be, hiring locals to work for you. Everything will be better in terms of the overall impact on the country. It's better when it's foreign investment direct. So they will come here, they will operate here. So they will basically be in Malaysia. So usually countries target this. We will discuss that later. However, now we must know that these things must be recorded in accordance to these three groups. So cash inflow, cash outflow. What is the transaction? Tell me more. Import, export. Okay, I put it in current account. What about buying machinery? Second. Lastly, I want to operate in China. Okay, so DFI in China. Let's move to the next slide. So let's focus on current account. Number one, what's the first item? Payment for merchandise and services. So merchandise exports and imports represent tangible, not intangible, it's tangible products that are transported between countries. Now service, exports and imports, nowadays services are even more important than goods. Represent tourism and other services. We've seen what happened to our economy here in Malaysia after the lockdown. No tourists. Businesses, especially small and medium enterprises, are suffering. We've seen many restaurants closing out. So what's the balance? Of course, the difference between inflow and outflow. So the difference between total exports and imports is referred to as the balance of trade. Of course, it can be positive and negative. Different countries, based different years, sometimes it changes. Factor income payment. What about income? If you have more income, does it affect? So it represents income. Interest and dividend payment received by investors or foreign investments in financial assets. So what if I am depositing my money in Indonesian banks for some reason. So every year I receive some interest from these banks. So this interest will also be cash inflow for Malaysia because I am here in Malaysia. Transfer payments, finally, what's transfer? We discussed it. After tsunami, many people sent aid to Japan. Sometimes, after a visit to some country and they treat you very well, you want to provide a gift. So it's all, again, it's playing with our inflow and outflow of cash. So it's going to be there. However, we follow this kind of categorization. Okay, let's take an example in the next slide. Let's go through these transactions together and try to see where shall they be recorded. Number one. So this is a current account transactions. Okay, so now we are focusing only on current account. However, in current account, we have three subcategories. Number one, international trade transactions. So not income, not transfer, trade. Trade, import, export. Let's go through the details. J.C. Penney purchases stereos produced in Indonesia. So now we are US. This is US. Why? Look at the third column. You see entry on US balance of payments account. Okay. So an American company's imports from Indonesia and sell it in US. What's this? Debit, right? US cash outflow. We pay money to Indonesia. Individuals in the United States purchase CDs over the internet from a firm based in China. So US people purchase online from China. So cash outflow similar to the previous, to China this time. But we don't care where does it go. We only care whether it's out or in. Mexican government pays a US consulting firm for consulting services provided by the firm. So we need help with services in Mexico. So Mexico hired American companies, okay? So we will receive income, cash inflow. IBM headquarters in the United States, purchasing computer chips from Singapore that it uses in assembling computers. Okay, again, cash outflow to pay people in Singapore. A university bookstore in Ireland purchases textbooks produced by a US publishing company. Usually, US publishes a lot of books. Many of the big publishers are in the US located. So again, we receive money, cash inflow, credit transaction. Now let's move to the second group, income transaction. So is there income flow? A US investor receives a dividend payment from a French firm in which she purchases stock. So an American girl purchased stocks in France. The stocks got dividends, profits must be distributed. So it's cash inflow to US. So we consider all US people and companies as US. The US Treasury sends an interest payment to a German insurance company that purchases US Treasury bonds. So insurance company, they invest in bonds. They lend you money. So basically every now and then you pay them interest. So cash outflow. So someone in Germany purchased your bonds. Now it's time to pay the periodical interest payment. Finally, a Mexican company that borrowed dollars from a bank based in the United States sends an interest payment to that bank. So someone from Mexico borrowed from us. Every now and then they pay interest. So this interest is cash inflow to US banks. So US. Finally, transfer. United States provides aid to Costa Rica in response to a flood similar to what happened in Japan. So cash outflow, gift, aid. Switzerland provides a grant to US scientists to work on cancer research. So someone want our scholars to focus on some kind of cancer. Okay, so they provided aid, help, gift, whatever you want to call it, cash inflow. Okay, let's move to the next slide. Now let's focus on capital account. So previously there was two accounts, current and capital. Capital basically included the financial. Previously, now they're separated. So now what do we see in capital account? Originally included financial account includes the value of financial assets transferred across country borders by people who move to a different country. So they move their assets with them. It includes patents and trademarks, relatively minor in terms of dollars when we compare it with DFI, direct foreign investment, what we call financial account. Finally, financial account. When we discussed it, we said countries aim for this. Why? Because it brings real value to the whole economy, not only the two parties transacting, but you come here, you buy land, you hire people to work in it, maybe contractors to build the building, like IKEA, you know, the huge building. How many people worked on this project from here, locals? Many. So basically, direct foreign investment is DFI is the most important aspect here. Investments in fixed assets in foreign countries. Portfolio investments, what about people who buy so much stocks in the US? Transactions involving long-term financial assets. So I invest in Apple, Google, Facebook, all American companies between countries that do not affect the transfer of control. Finally, other capital investments, something that is not actually in these two categories will be here, like, you know, other income, other expenses. So other capital investments, transactions involving usually short-term financial assets, not long-term, short-term, such as money market securities. So we try to segregate these subcategories because each one is different. One is long-term, one is gonna end soon, within 1 year. Now let's continue with trade volume. So back in the days, we heard many stories about people traveling from here to there to sell and buy goods. However, now it's more often. Of course, technology played a massive part, and we discussed that there were some institutions that facilitated the volume increase. They helped us basically by preserving rights for buyer and seller, etc., protecting DFI companies, issuing laws. So there were events that increased the level of trade over the years until we reached this level we witnessing right now. You go to a supermarket, 7-Eleven, it's everywhere in the world, almost same products, you know, everything is similar. So what made things become like this? Many events that happened gradually one after another. It began with the removal of Berlin Wall, then to the Single European Act, then North American Free. I'm sure you've heard of it. NAFTA allowed US firms to penetrate product and labor markets that previously had not been accessible. In 1987, Single European Act, industrialized countries in Europe agreed to make regulations more uniform, to make it easy to standardize things. General Agreement on Tariff, GATT, called for the reduction or elimination of trade restrictions on specified important goods over a 10-year period. Why? To improve business between these neighboring countries, to make sure you all become better. So all of these 10 countries will benefit somehow from it. So on the macro level, on the world level, they all benefit, they all become stronger. We've seen that in Europe, right? Inception of the euro, so that's when it started to become real in Europe, unified, reduced costs and risks associated with covering one currency to another. So now you don't have to worry, you're already using one currency, right? I saved you so much time to hire people to do the exchange. We've seen how important exchange rate is for, trade in general. So now I can basically ease your pain by providing you with one currency. Imagine we, Indonesia, Thailand, Singapore, use the same currency. Buying and selling would be much easier. And of course, expansion. It expanded later on, reduced restrictions. You don't need a visa. You can travel to Spain and take the car, go everywhere you want in Europe. Finally, other trade agreements. United States has established trade agreements with many other countries. So, do you have to be a part of one of these? No, you can have, one agreement with a country, another agreement with another country. Usually Israel does that all the time. It's hard for them to enter one group of countries, especially if there are Muslims among them. So they try to do it one by one. So all countries over the world, they have strong relations with some countries, or they are a part of a whole group of, unified laws and restrictions and instructions to do trade, etc. Okay? Now, let's move to the growth in international trade, continue with outsourcing. Okay, so what is outsourcing? Over the last few years, we started to hear so much about outsourcing. So, what is outsourcing? Of course, we already know it. There is something I want to do, but I don't want to do it myself in my company, so I basically hire someone else. We call it outsourcing. However, when we discuss it on international level, it's different. So now I'm hiring people from outside of Malaysia doing my business. For example, the best example here is IT. Many countries all over the world, they hire IT engineers from India. Stay in India, do this task every day. That's it. I'll pay you double what you get paid in India. That's still cheaper than what we pay IT engineers in Malaysia. So instead of hiring 10 Malaysian engineers, paying 10,000 each, 100,000, I hire 10, maybe better quality, because IT engineers in India are very popular to be really good, and paying them half only. So cut cost. Is that good for the business? Of course. Lower cost, higher profit. So it's a win-win situation. Indian engineers are happy. I am happy too as a company. So what's the outsourcing? Let's begin with the definition. It's the process of subcontracting to a third party in another country to provide supplies or services that were previously produced internally. In our case, it was a service. It can be a supplies. Instead of buying raw materials from Malaysia, I found it cheaper in Egypt. I start to import it from Egypt. Same with our example. So what's the impact? Increased international trade. It's good. Now we increase the international trade. It's good for the world, right? MNCs now purchase products and services from another country. More importantly, lower cost on operations. Now I can compete on the international level. Why? Because I managed to lower my cost, so now I can offer lower prices that can be very competitive worldwide. However, the bad point here, the negative point, is outsourcing is hiring locals. What about Malaysian IT engineers in our example. Who's gonna hire them? Who's gonna buy the raw materials from our Malaysian suppliers? So outsourcing may reduce jobs in the countries that are implementing it. So Malaysians might oppose to that. Why? Because now no one needs IT engineers in Malaysia, and when demand decrease, their salary will decrease, they will be suffering. And not only this, in the long term, it harms the whole sector because it doesn't develop anymore, because no one is interested in becoming an IT engineer in Malaysia because every company is hiring Indians. So you see now there are pros and cons, same with anything in life. Let's continue. Managerial decisions about outsourcing. So, shareholders may suggest that the managers are not maximizing the MNC's value. So, I have a manager, CEO in, let's say, Petronas. I am the shareholder. I am the major shareholder. What's my interest? Why did I hire my CEO in Petronas? To maximize my profit, to make me more profitable. That's why I'm paying him so much money. How can he maximize my profit? Minimize the cost. How can he minimize the cost? One effective way we just discussed is outsourcing. So now, who shall serve? Who shall the CEO serve? The country people and provide them with jobs, or me who hired him? So you see here, managers should consider the potential savings that could occur as a result of outsourcing. So usually governments take care of that, not the CEOs, because again, the CEOs must be working for the best benefit of the shareholder. However, if Malaysian government said you cannot hire more than 50% of engineers from India or outside of Malaysia, then you must hire Malaysian engineers. Trade volume among countries. So I will end this part here. We will continue in the second part. Sorry for the